Using trend lines on a trading chart is one of the simplest and most effective ways to understand market direction. A trend line is a straight line that connects two or more price points and then extends into the future to act as a line of support or resistance. To draw an upward trend line, you need to find at least two higher lows in an uptrend. And for a downward trend line, you connect two or more lower highs in a downtrend. The more points a trend line touches, the stronger it is considered. When you're analyzing a chart, start by zooming out a bit to see the bigger picture of where the market is heading. Look for clear peaks and valleys, where price changes direction. Then use your charting tool to draw a line along those points without forcing it to fit perfectly. The market is not always neat. Trend lines help you spot ongoing trends, and when price bounces off a trend line multiple times, it shows that traders are respecting that trend. A break below an upward trend line could suggest a trend reversal or a weakening move, while a break above a downward trend line might hint that bulls are gaining strength. Traders often use trend lines with other indicators like RSI or MACD to confirm signals and avoid false breakouts. One mistake beginners make is forcing a trend line where it does not belong or drawing it through obvious price bodies, instead of connecting the important wicks or shadows. Always aim to connect the points that show true market reaction rather than random noise. Another thing to remember is that trend lines are not forever. They must be adjusted as new price data comes in. Sometimes what looked like a solid trend line can become invalid if market behavior changes. You should also watch for steepness. If a trend line is too steep, it may not last long because strong moves are often followed by corrections. A moderate angle usually signals a healthier and more sustainable trend. Trend lines also help you decide on your entry and exit points. In an uptrend, many traders look for buying opportunities near the trend line, setting their stop loss slightly below it. In a downtrend, traders often look for selling opportunities with stops slightly above the trend line. You can even use parallel trend lines to create a channel, helping you visualize where price might find both support and resistance within the trend. Remember, no tool works alone, and trend lines should be part of a bigger plan that includes understanding support, resistance, risk management, and market context. The more you practice drawing and using trend lines on different time frames, the better you will get at spotting real trading opportunities and avoiding traps that less prepared traders fall into. Trading with trend lines is simple but powerful when done patiently and with attention to detail.